Welcome to the deep dive. Today, we're looking at something pretty special, I think. Not just market history, but more like a blueprint for building wealth over the long haul.
Yeah, that's right.
We're diving into Peter Lynch and his, well, legendary approach. Growth at a reasonable price, JRP.
JRP, yeah. It really is sort of the golden mean of investing, isn't it? It's this disciplined way of finding that sweet spot.
Sweet spot.
Yeah, blending the careful price watching of value investing with the upside potential you get from growth stocks.
Right.
It's about trying to avoid paying crazy prices for growth, that growth at any price thing.
Yeah.
But also, avoiding those deep value stocks that might just stay cheap forever.
And the results he got with this, they're just incredible. Lynch ran the Fidelity Magellan Fund, what was it, 77 to 90?
That's the period, 13 years.
And over those 13 years, he averaged 29.2% per year.
Astonishing number.
I mean, the S&P 500 did about 15.8% then. He almost doubled the market. Think about that, turning $10,000 into nearly $280,000.
Yeah, and that wasn't just luck, right? It came from a process, a repeatable system.
Okay.
So that's our mission today, really, to unpack that system. It's a mix of hard numbers, quantitative stuff, but also a lot of qualitative common sense.
The core idea being?
Find solid, sustainable earnings growth that the market just hasn't fully recognized or priced in yet. That's JRP at its heart.
Okay, let's get into the toolkit then. The quantitative side. Lynch's most famous tool has got to be the PEG ratio, right?
Absolutely. The PEG ratio. The standard PE ratio, price to earnings, it's okay, but it only tells you about past earnings.
Right, it's backward looking.
Exactly. The PEG ratio adds that crucial forward look. It brings in the growth dimension.
How does it work, simply?
Well, it's just the PE ratio divided by the annual earnings per share growth rate, the EPS growth.
Okay.
Lynch's big insight was this. A high PE isn't necessarily expensive if the company's growing really fast.
Makes sense.
So the PEG formalizes that. Basically, the faster the growth, the higher the PE you should be willing to pay.
And the target number he looked for?
He famously aimed for a PEG ratio of 1.0 or less.
1.0 or less.
Yeah. So if a company's growing earnings at, say, 25% a year, and its PE ratio is 25.
Then the PEG is 1.0.
Exactly. And Lynch would say that's probably a reasonable price, fairly valued.
Okay, but here's where I always get a little hesitant. That G in the formula, the growth rate, how reliable is that? Aren't forecasts often wrong?
That is a critical point, absolutely critical. And it's why JUP isn't just punching numbers into a formula. It's a philosophy.
Meaning?
Meaning you, the investor, have to do the hard work. You need to really dig in and validate that growth rate yourself. Is it sustainable? Is it realistic? The PEG gives you the framework, the context.
So it hinges entirely on believing that growth number.
Precisely. Your own research has to back up that growth story.
Let's maybe use that classic example to make it clearer. The two tech companies.
Oh yeah, the aha moment example. It works well. So imagine two companies, maybe in the same sector, tech let's say, both trading at a PE of 30.
Okay, so on the surface, they look equally expensive.
Right. But company A is growing its earnings at a whopping 40% per year.
Okay.
Its PEG is 30 divided by 40, which is 0.75.
Below 1.0.
Right. Now, company B, maybe it's struggling a bit, only growing at 15% per year.
Same PE of 30.
Same PE of 30. So its PEG is 30 divided by 15, which is 2.0.
Way above 1.0.
Exactly. So even though they have the same PE, company A, the faster grower, is actually trading at a much more reasonable price relative to its growth.
That makes it crystal clear. Company A is the JRP winner there.
Definitely.
But Lynch didn't just hunt for these super fast growers, did he? He had categories for other types of stocks, like the big, steady ones, the stalwarts.
Right, the stalwarts. Yeah, for those more mature, maybe slower growing companies that pay dividends, think, the Coca-Colas or Johnson & Johnson's of the world. He tweaked the formula a bit.
How so?
He used what's sometimes called the yield-adjusted PEG ratio. He'd add the dividend yield to the earnings growth rate in the denominator.
Ah, okay.
Yeah.
Why add the yield?
Well, because your total return isn't just from the earnings growth, right? It's also from the cash dividend you receive.
Right. Total return.
So if a company is growing at, say, 12%, but it's also paying a 3% dividend yield.
Your potential total return is closer to 15%.
Exactly. So by adding that yield into the denominator, he made sure he wasn't automatically discarding a solid, stable company just because its pure earnings growth didn't quite hit that 1.0 PEG target. It gives a fuller picture for those reliable cash generators.
Okay, makes sense. So beyond the PEG ratio, Lynch was big on checking the actual health of the business, wasn't he? not just the growth forecast.
Absolutely. He was actually pretty skeptical of hypergrowth. Companies growing consistently over 50% year after year.
Why skeptical? Isn't faster always better?
He saw that kind of extreme growth as often unsustainable. Maybe it's fueled by a fad or it attracts crushing competition really quickly. It's just hard to maintain.
So he preferred something more controlled.
Yeah, the GARP sweet spot for him was more like consistent, sustainable EPS growth between, say, 15% and 30% annually. Okay.
Fast enough to really build wealth, but potentially manageable and repeatable over time.
And he had some simple operational checks, too. I always liked the inventory versus revenue growth test. Seems like pure common sense.
It really is. It's a great red flag, especially for retailers or manufacturers.
How does it work?
If you see a company's inventory, the stuff sitting in warehouses piling up faster than its sales are growing consistently, that's a worry.
Suggests problems.
Yeah, it could mean demand is weakening, or maybe their products are becoming obsolete, or they're just mismanaging things badly. You want to see the opposite.
Sales growing faster than inventory.
Right. Strong revenue growth outpacing inventory buildup. That helps confirm the demand is real.
Okay. And then there's the financial strength side, the margin of safety. Lynch famously hated debt, right?
Oh, yeah. He was really wary of debt, especially for younger growth companies. If they hit a bump in the road, too much debt could be fatal.
So how did he quantify that? Well, quantitative models, based on his thinking, often screen for a low debt ratio. Specifically, looking for a 3 of category. Total liabilities to assets ratio of maybe 25% or less.
Keeping the balance sheet clean.
Exactly. Gives them resilience if the economy turns down or if their growth slows unexpectedly.
And we mentioned PE relies on earnings, which can sometimes be fuzzy. Lynch focused on actual cash, didn't he?
Yes, real cash. That's why looking at free cash flow, or FCF, is important.
Remind us what FCF is.
It's the cash left over after a company pays its operating costs and invests in necessary capital expenditures like new equipment or buildings.
Right.
It's the cash management can actually decide what to do with.
Like pay dividends, buy back stock.
Or fund more growth, yeah. So if you look at the price to free cash flow ratio, PSCF.
Lower is better?
Generally, yeah. If a company's PSCF ratio is lower than its industry peers, it might suggest the market isn't fully appreciating its cash-generating ability. FCF often tells a clearer story than reported net income.
Okay, now let's shift gears a bit to the part of Lynch's approach that really resonated with everyday folks, the qualitative side, the famous mantra, invest in what you know.
Right. This is where he argued ordinary people actually have an edge over Wall Street pros.
How so?
Because you, the listener, interact with companies constantly. As a customer, maybe as an employee, or just through your hobbies. You might spot a great local restaurant chain that's expanding, or notice everyone suddenly using a new product long before it shows up on some analyst's radar in New York.
But here's the catch, right? People hear invest in what you know and think that's the whole story. Just notice something cool and buy the stock.
Exactly. And that's the big misunderstanding. That observation, that's just the start. It's the hypothesis.
It's not the investment thesis itself.
No, you have to follow it up with the homework. The rigorous research, he called it kicking the tires.
So check the numbers.
Check the numbers, check the management, check the competition, check the balance sheet. Does that popular store actually make money? Does that hot tech company have a mountain of debt? If you don't connect the observation to the fundamentals, it's just anecdotal. It's not investing.
And he had a great way to make sure you actually understood the business before investing. The crayon test.
Ah, the crayon test. Brilliant in its simplicity.
Explain it.
He basically said, if you can't explain what the company does, how it makes money, and why it's going to succeed, in simple terms that a 10-year-old could understand, well, then you probably shouldn't invest.
Forces clarity.
Total clarity.
Yeah.
It stops you from investing in things that are just too complex or opaque, where you don't really grasp the risks.
And that clarity was needed because Jarper wasn't just one single strategy for him, was it? He famously broke stocks down into categories.
6 categories, yeah. This is crucial because you don't analyze a giant, stable company the same way you analyze a tiny startup or a cyclical industrial firm. The approach has to be tailored. His main hunting ground for those huge winners, the 10 baggers, was the fast growers.
These are the potential rockets.
Yeah, smaller, aggressive companies capable of maybe 20–25% growth or more per year. High potential, but also higher risk.
Then you had the stalwarts, the big guys.
Right. Large, stable, well-known companies, maybe growing slower, say 10–20%. But they're reliable. They often pay dividends. Lynch saw these as portfolio anchors, the defensive players you hold on to during downturns.
Always have some stalwarts, was his advice.
Pretty much, yeah. They provide ballast.
Okay, next up, Cyclicals. These sound tricky.
They are tricky. Think autos, airlines, steel, chemicals. Their fortunes rise and fall dramatically with the overall economy.
So the usual JR rules don't quite apply.
Not in the same way. With cyclicals, Lynch said timing is everything. The time to buy them, counterintuitively, is often when things look absolutely terrible.
When they're losing money.
Exactly. When losses are piling up, the PE might even be negative. You buy based on the expectation of recovery when the price is reasonable compared to their potential earnings in a normal economy, not their current depressed state.
That takes guts.
It does. It's contrarian.
Yeah.
And you have to be prepared to sell when the cycle turns up again.
Okay, what about the other couple of categories? The riskier ones.
Right, you have turnarounds. These are companies that have been beaten down badly but might have a shot at recovery.
What drives a turnaround?
Could be new management, a major restructuring, selling off a bad division, something that fundamentally changes the story. The G here isn't steady growth. It's the potential snapback from deep trouble towards profitability. High risk, high reward.
And finally, asset plays.
Yeah, these are interesting. Asset plays are companies where the value of their underlying assets, things like real estate, maybe a pile of cash, patents, even brand names, is significantly greater than the value the stock market is putting on the whole company.
Hidden value.
Exactly. Lynch loved digging for these. Maybe a retailer sitting on incredibly valuable downtown property that the market was ignoring. It takes deep dive research to uncover these.
Okay, let's make this concrete. A fast grower example, Taco Bell.
Perfect example. Lynch noticed Taco Bell early on. It was a simple concept, easy to understand.
The crayon test.
Passed the crayon test. And importantly, institutional investors were largely ignoring it back then. Maybe thought it was too small or just fast food.
So he saw an opportunity others missed, and the numbers.
He kicked the tires, found the company had excellent unit growth, a scalable model, and, crucially, no debt.
The debt thing again.
Yeah, that gave them huge flexibility to expand without financial strain. And when the market got nervous and the stock dipped temporarily, he saw it as a buying opportunity because the underlying business was still firing on all cylinders, growing profits around 25% a year.
And it became a massive winner.
Huge home run, eventually bought by PepsiCo. Classic GARP fast grower story.
Now contrast that with a cyclical Ford Motor Company. This sounds like the opposite situation.
Completely different playbook required here. Lynch bought Ford in the early 1980s during a brutal recession for the auto industry.
How bad was it?
Ford was losing staggering amounts of money. Over $1 billion in 1980 alone. The headlines were terrible. The PE was negative.
So how on earth was that a reasonable price, according to GARP?
Because for cyclicals, the reasonable price isn't based on current terrible earnings. It's based on what the company could earn in a normal economic environment once the cycle turns.
So he was betting on the recovery.
Exactly. He was buying when the stock price reflected maximum pessimism, maybe even fears of bankruptcy. He understood the cyclical nature of the industry, saw management was cutting costs, and believed demand would eventually return.
And the bet paid off.
Massively. The stock went up something like 500% or more over the next decade as the economy and Ford recovered. Pure cyclical investing, GRP style.
That really shows the flexibility, doesn't it? Applying the core idea growth at a reasonable price, but adapting the method based on the company type.
That's the genius of it. But it leads us to think about GARP today.
Right. How does it work in the modern market?
Well, there's a bit of a paradox. The quantitative screening part, finding stocks with a PEG under 1.0, low debt, etc. That's easy now. Anyone with the basic stock screener can do it in seconds.
So that initial screening doesn't give you an edge anymore?
Not really. The simple quantitative filtering, that alpha is largely gone because it's too accessible.
Okay, so if the screener is just table stakes now, where is the edge for a modern GARP investor?
The edge has shifted almost entirely, I think, to the qualitative side and the deep proprietary research.
Meaning?
Meaning the real work now is figuring out if the market's consensus forecast for growth, that G that everyone plugs into their PEG calculation, is actually wrong, specifically if it's too low.
So you need to find something the market is missing.
Exactly. You need to do the legwork to uncover a reason why this company will grow faster than analysts expect. Maybe it's a hidden competitive advantage, a new product line the market underestimates, superior management, a structural shift in the industry. Your research has to give you confidence that the G should be higher. The screener just gives you a list of candidates to start digging into.
That makes sense. And that focus on growth, even if you're looking for a reasonable price, that protects you from value traps, doesn't it?
Precisely. A lot of stocks are cheap for a very good reason. their business is dying.
They're melting ice cubes.
Right. GARP, by demanding growth as part of the equation, forces you to look for companies with at least some forward momentum. It steers you away from just buying cheap stocks that are actually in terminal decline.
So when you put it all together, this JAR approach, it seems built for the long haul. Maybe not always the flashiest, but solid.
I think that's the key takeaway. GARP is about resilience. Its real power isn't necessarily about getting the absolute highest return in a roaring bull market. Sometimes pure, expensive growth stocks might outperform then.
Right.
But GARP's strength lies in minimizing the damage during bear markets, during downturns. That focus on reasonable price and financial health provides a cushion. And over a full economic cycle, that often leads to smoother and ultimately better risk-adjusted returns. Resilience is how you compound wealth effectively over decades.
Minimizing losses can be just as important as maximizing gains. That's a powerful final thought. Now, speaking of market conditions, for those of you interested in tracking the overall market temperature, you might want to check out the iOS app Buffett Indicator. You can find it in the Apple App Store.
Yeah, the Buffett Indicator app can be a useful tool. It gives you a sense of overall market valuation, which can provide some context for your individual GARP investment decisions, helping you gauge if the market environment is getting frothy or looks more reasonable.
Good point. And just our standard reminder, all the analysis we've discussed today is based on publicly available information. It's for educational purposes, okay?
Right.
It's definitely not investment advice. Always do your own homework, your own due diligence before making any investment decisions.
Absolutely. And hey, if you enjoyed this deep dive and want to hear more discussions like this, please subscribe to us on Apple Podcasts or Spotify. Just search for Deep Value Investing.